Hey folks, Dan Frio here with your closing bell for October 24th, 2024. So mortgage rates, well, we'll take that. At least it's not going up. Okay, so what's the question that we have for today? It's right here. It's in the headlines. Why are rates back near 7%? So that's what we're going to try to tackle today. But had an interesting development today. This happened today and I didn't even know it. So what happened is I had Nations News or News Nation reach out to me and they're like, we're doing a segment in Chicago and we're doing it in regards to the housing market. Would you be interested in being a commentator? And I'm like, sure. And you can notice I have the same outfit on that I had on this morning. So check out that video. It was pretty cool to be live on TV because my whole staff was on the other room watching it. So pretty cool. So now let's get to that question that everybody has. Why are rates back to 7%? Well, there's a lot of basically debates about this. Some people are saying the election is causing people to just be secure. Other people like myself say it's that plus the debt issue problems and we have all over the place. But there was an interesting article or an interesting interview on CNBC today. And the reason why I do this, folks, is there's thousands and thousands, millions of videos out there a day. I try to choose one in the morning and one in the evening that gives you the most bang for the buck. So you don't have to check everywhere. So I usually try to make it in housing and real estate and what's going on behind the scenes. And I try to get interviews with analysts that CNBC has. So you can not only just take it from me, what is mainstream media and what's Wall Street saying about this? So let's get over to this interview, see what his take on it. But you can see right through here, the MBS market, well, it just ticked up one more tick to plus 0.07. So will mortgage rates come down a little bit more? Will this trend continue? Well, let's check out the interview.
Among the positive gainers today, stronger new home sales data propelling some of those stocks. Housing-related names are getting a boost. But what do the numbers actually mean for the overall sector? So is this a blip or the start of something sustainable? Our next guest is here with some insight there. So joining me now is Jim Egan, the co-head of U.S. Securitized Products Research over at Morgan Stanley. Jim, many of those securitized products deal with mortgages and financial instruments tied to mortgages. What does the data show you, and what does that mortgage information kind of tell you about what the broader state of the housing market looks like?
Absolutely, and thank you so much for having me. As you mentioned, we had a strong new home sales print this morning. If we take a step back, there are a number of different ways to kind of crack the housing market, a lot of different statistics that we look at. But one of the big drivers is affordability. And yes, there's been some volatility in mortgage rates. Mortgage rates have increased a lot over the past 3 weeks. But if we take just a wider view from the fourth quarter of last year to today, mortgage rates are down over 100 basis points. Affordability is improving. And as we see that affordability improve, you've seen mortgage applications increase. When we take a closer look, that application increase is a little bit more skewed, or it's definitely been driven by refinance applications. Purchase applications have kind of bounced along unchanged for the better part of 12 months, but that's not too unusual. We look at prior periods of affordability improvement, it sometimes takes 9 or 12 months for purchase applications really to pick up. And as you saw this morning, and if you contrast it to the data yesterday, we're seeing those pick up a little bit more significantly in new home sales than existing home sales.
Now, Jim, with all of that in mind, is there a way that investors out there can read some of this data and figure out whether or not the housing market is due for that sustained move higher, despite the fact that they've already been outperforming in certain key parts of?
Okay, shameless plug. How you learn this stuff and keep up to date with it? Watch me every day. Don't forget to subscribe right down over there and hit the bell so every time I post a video, you get an alert. But let's go back to the commentary.
This market rally.
Right. So when we think about those underlying kind of fundamental housing statistics, where home sales are going, where building volumes are going, as I said, purchase applications holistically kind of treading water for the past 12 months. But the second half of September, the first half of October, showing year-over-year growth in purchase applications really for the first time since 2021. It normally takes that 9 to 12 months to see sales volume start to increase. Those purchase application increases kind of might be the first signs of that growth. And so from our perspective, we think in the fourth quarter of 2024, where we are right now, that's where we might be entering that sweet spot from a growth in sales volumes perspective. We don't think the growth will be as significant as it's been in prior periods of affordability improvement, despite the fact that affordability has improved, it's still a lot more challenged than it's been at really any point in the past 30 to 40 years, with the exception of 2023. And the absolute supply of homes available for sale, it remains pretty tight, but we do think you're going to see growth. We think existing home sales are going to grow by about 5% over the next 12 months. And we think that new home sales, like you saw this morning, should continue to outpace existing home sales because the lock-in effect, one of the key buzzwords in the housing market, has kept existing listings pretty low. And you've seen more of a response from the supply in the new housing.
All right. James Egan with Morgan Stanley saying that homeowners across America can be cautiously optimistic. Jim, thank you very much. We'll see you soon.
Yeah. So
Thanks so much for having me.
Dom Big.
I'd have to give him a double thumbs up on that. Everything he said, I can confirm. About a month ago, I talked to many of our lenders that we deal with because I'll tell you, I'll explain who I am for those that don't really know. I'm actually a mortgage loan officer, and I'm licensed in all 50 states as well as Puerto Rico. So we're a large mortgage broker. And I've talked to several of our investors over the last couple of weeks, and they're like, it's crazy how the refinance has changed. It went from about a 90-10, where 90% of all loan applications were purchases and 10 were refinance. They balanced out to almost a 50-50. So with this big jump in rates so fast, you're going to see that refinance volume dry up quite a bit. And then we're also coming to that part of the year, so October, November, December, where the holidays are hitting and people they're not, the home sales usually drop. So what you'll see is inventory starting to come down a little bit. In most cases, prices will get cut for those that are on the market because of seasonality, people that need to sell their houses. A lot of people that don't need to sell, they're going to wait till springtime next year to put those houses back on the market to see what they can get at that time. But these the increase in rates that we saw over the last couple weeks since the Federal Reserve dropped rates I've never seen this before in my life, where the Federal Reserve come in and drop rates, and you saw basically rates on the upside do identically on the rate cuts that the Fed cut rates 50 basis points, and then within a week or so, mortgage rates went up about 50 basis points. So that's a 0.5%. So what he was talking about previously is saying, last year, rates were 8%. So here's the bond market that we follow on a daily basis. So it's right through here. Okay. So if you look at today's numbers, the MBS market right now is up 6. So that's already built into the prices. So rates are down 0.01. So nothing really to write home about. But here's where we were last year. So the price of the bond was down here, way down here. And here's where we are today. You have to understand, when the price of a mortgage bond goes up, the yields go down. Okay. So all of a sudden, though, we had mortgage rates just completely spike. So this was a good, since October of last year, rates got better and better and better and better. And then we had that huge move since the Federal Reserve cut rates. And it's about right through here where they cut rates, and they've been, again, there's an inverse relationship here. So as this price goes down, the rates go up. So that's what you're seeing right through there. So there's really not much information in the charts today on the economic calendar. So let's get over to the major indices to see how they fared for today. So we have the Dow Jones down 140, S&P's in the green, NASDAQ's in the green. Thank goodness, too, for Tesla. They just came out and blew away their earnings. I think Tesla's stock's up about 20 or 22% today. So you see a nice action here. The VIX is coming down. Let's see, cryptocurrency, is it still on its run? Just over $68,000 right through there. Oil's nice. That's nice. It's down right about $70 a barrel. That's keeping inflation in check. So European markets, they're looking well. They were all red yesterday. So news right now is starting to simmer down. The election's just not too far away. So within the next 2 weeks or 3 weeks, we have a Fed meeting and we have an election. And if that doesn't really cause anxiety in you, I don't know what you're doing behind the scenes. So that's what we have so far today. Based on the news that we have so far today, though, the good news is there's now a 90. Let me show you to you. There is a 95% probability that the Federal Reserve will cut rates down to 4.5 to 4.75. So check out my YouTube channel if you guys would. If you're looking for an opportunity to refinance, go to the rate update. What you could do is actually choose the interest rate you want to refinance at. Okay, so what you're going to do is fill out this information. Soon as that rate hits where exactly you want it to be to refinance, we'll be getting you on the phone to go over the numbers, any costs involved with that, and to let you know your opportunities on a refinance. But if you're out there trying to look and buy that first house, I have to suggest going to the rate update and checking these 2 grant finders that we have. Not a lot of people are using these. I don't know why. The Chicago grant's going to give you $10,000 to use for down payment and closing costs, and the national grants are basically free money to use. So check those out. You can hit the apply now button to get started right now, or you can scroll down right through here. That's probably what I would do, and I would call us. The number is 844-775-5626, or you can reach me personally, yes, Dan Frio, at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic night. Check out my video this afternoon from when I was on TV. Pretty cool. Thanks for watching. Bye-bye.